What if you could see exactly where the big institutions buy and sell, and follow their footprints instead of fighting them? And what if you could read the market the same way Munihisa Homa did, the man who made the equivalent of $10 billion, using nothing but candlesticks and human psychology 300 years ago? Today, I'll show you how to combine his ancient Japanese method with modern smart money strategies to build a 5-minute scalping system that moves with the banks, not against them. Here's what you're about to learn in this video. Who really moves the markets? How big institutions buy and sell without you noticing? How to spot institutional areas before the move happens? How to validate the strongest smart money zones? How to use Munihisa Homa's 300-year-old candlestick secrets for perfect entries? The 5-minute scalping strategy that works on any market. How to trade with the banks, not against them. The simple risk management rule that keeps you profitable for life. By the end of this video, you will read the market like institutions do. Predict the next market moves before they even happen. Adapt ancient wisdom to today's market dynamics. Apply a simple but powerful 5-minute scalping. Alright, now that you're ready, let's start from the core. Because before you can trade like smart money, you need to know who really moves the market. It's the giants, central banks, hedge funds, market makers, and massive financial institutions controlling billions, sometimes trillions. When they move, the entire market follows. Look right here. The market was calm, almost asleep, and then out of nowhere a strong move down. Who caused this? A retail trader with a $1,000 account? Of course not. This was a big bank or a financial institution executing a massive sell order. But why did they sell? Maybe a high-impact economic report dropped, like an interest rate decision, inflation data, or a bad employment report. Maybe their analysts spotted a macro imbalance or liquidity void. Whatever the reason, they acted, and that action left a footprint on the chart. The market was quiet again. Then suddenly a strong bullish push, clearly another institutional order, a wave of buying pressure. But here's where it gets interesting. After that move, price retraces back to the origin of the impulse and then moves up again. That area where price bounced? That's not random. That's what we call a demand zone. Here's what happens. When a big institution decides to buy, it can't execute its entire order at once. Imagine a bank wants to buy $250 million worth of euros against the US dollar. They can't just click buy. There simply aren't enough sellers available instantly. So what do? They might buy 100 million first, pushing price up, then wait. When price retraces back to the zone, they use that pullback to fill another 50 million, and another opportunity to fill another 50 million. Once the market keeps rising, they complete the remaining order. And that's why you see this pattern again and again. Strong move, followed by a retracement, then a continuation. It's not magic, it's the institutional footprint, the trace left behind by big money. So as a retail trader, what's your real job? Is it to analyze GDP growth, or read central bank reports, or track corporate earnings? No. You don't have access to the data they have. And even if you did, your $10,000 can't move the market an inch. Your real job is this, to scan your chart and spot institutional footprints. Because those footprints show you where institutions have already acted, and where they're most likely to act again. And the most powerful of these footprints? Supply and demand zones. This is the core of our strategy. I'm going to teach you exactly how to spot where institutions bought and sold, how to identify the zones they're likely to defend, and how to enter the same trades they take, with precision, confidence, and discipline. So please, don't skip any part of this video. Every concept connects to the next. If you miss even a small detail, the entire strategy could fail, and you'll miss what separates losing traders from professionals. Let's start with supply zones. A supply zone is a price area where selling pressure becomes dominant, so strong that it stops price from going any higher. You'll often see it appear after a powerful bullish move, a big rally where the market suddenly reverses. Why does that happen? Because institutions that bought early in the move are now taking profits, unloading huge positions. And when those sell orders hit the market, they overwhelm demand, sending price sharply downward. It's not just sellers entering, it's smart money exiting. That's the difference. Now, on the flip side, we have demand zones. A demand zone forms where buyers step in with force, preventing price from falling any further. Usually it appears after a market drop when price reaches a level institutions see as cheap, a value area. They start loading up massive buy orders, and because their orders are so large, price reacts explosively upward, creating that beautiful rally we see on the chart. It's not random, it's institutional accumulation, the moment smart money quietly enters the market before the big move happens. So, in short, supply zones are areas where institutions sell or distribute their positions. Demand zones are areas where institutions buy or accumulate their positions. Now that you understand what supply and demand zones really are, let's take it a step further. If you want to predict where the market will move next, you need to recognize the 4 footprints that institutions leave behind. These patterns are like the DNA of smart money activity. They reveal whether the market is preparing to reverse or to continue its trend. Once you master them, you'll start seeing the chart the same way institutions do. Alright, let's break down the first institutional footprint, the drop base rally. This pattern tells the story of accumulation after manipulation. Here's how it unfolds. First, price drops sharply. That's not random weakness. It's smart money driving price lower to hunt liquidity, forcing retail traders to panic sell and trigger their stops. Then, price pauses and forms a base. That's where institutions quietly start accumulating buy positions, while the rest of the market is uncertain. And finally, comes the rally, the explosion upward. The moment institutions unleash the second half of their orders, sending the market flying, that whole formation, the drop, base, and rally, becomes your demand zone. When price comes back to this area later, it often bounces hard again, because the remaining institutional buy orders are still waiting to be